The biggest risk that an investor or a banking sector faces, and the first risk that we look at, is political risk. And if you have problems with political risk, then you have major problems. Having said that, Bahrain has by and large withstood and managed to able to meet the challenges. When you look at the commercial sector, the commercial banking sector from a number of perspectives, whether it's capital adequacy ratios, whether liquidity ratios, they're still in a very comfortable zone. However, going forward, the underlying assets, that's the asset they book in the country itself, if you do not see an improvement in the economy, then you're likely to see a deterioration of the quality of those assets. So to a certain period of time, you'll be able to manage that situation. But going further, you cannot have that situation being sustained, because the biggest factor that you face is uncertainty. And when there is uncertainty, people will start not to participate in the market. They'll tend to delay purchase of goods and services, delay investment decisions, because of that uncertainty. And it's our understanding that, Bahrain has just recently announced a large expansionary budget that hopefully will start then to get the whole economy moving on a fast track. But I anticipate, and I'm looking at the layman here, that the first thing that the government wants to do, it wants to settle the political issue. There is another aspect of the banking sector, which I have not mentioned, which is the investment banks. The investment banks in Bahrain faced a challenge earlier from the fallout of the global financial crisis. And therefore, those banks still have what I would term as legacy issues, irrespective of the crisis of what happened in Bahrain, that they need to manage. And it's going to be very difficult for them going forward on that. But there are other banks who have been, in a different situation. They are still quite well capitalized, and moving forward, the future holds some promise. I use that word "some promise" because the regulations for the investment bank is going through a major changes that the investment banks need to look at. And I will explain later in the discussion, because the economic model that we use here as investment banks is quite different to what you have, for example, in Europe and the United States. The global financial crisis, look for somebody to blame. And the banks have been in the forefront, rightly or wrongly. And the investment banks in particular have been in the forefront to blame. With respect and briefly, I think this is a very simplistic way of trying to respond to a problem. The simplest thing is to say so-and-so is to blame. It doesn't make the problem go away, all right? And it doesn't necessarily mean that that person is guilty, all right? But be that as it may, there is a heavy emphasis today globally, and not just in Bahrain, to try and manage and control investment banking activity in order not to have a repeat of the past global financial crisis. The challenge for us, today, it's not the question of too much regulation, because at the end of the day, you live in a global village, as we say, and you need to consider also that having, similar regulation as elsewhere, because in order for you to be accepted as an accepted member of the global financial market, I cannot have different rules, and each one of them, or totally different rules, and we still trust in each other. We have to have a common ground in order for us to work together. One aspect that I think, and I keep emphasizing, which is important, it's not the change of regulations. It is the speed of adoption which I have a concern about. What I see in the region here, among a number of central banks, is that the need to adopt new banking and regulations, in a very, very quick time. The alternative, I think, is to have adoption, but to stretch that option over time in order to allow a smooth transition into a new business model. Adoption of regulation is not switching a tap on and off. Adoption of regulation requires so many little moving parts to be put in place. And I think the regulators in this region are making a major mistake by pushing these regulations too quickly. I think what could happen, they could stretch them. Let it take 5, 6, 10 years even, all right? With proper timeline objectives, over that period in order to ensure there is proper progress taking place, all right? The alternative, I think, by these quick adoptions is that you're going to see failures, all right? Or that type of business being closed. And reopening of that kind of business, of investment banking business, will take years and years, for it to come back again. All we're going to end up with are commercial banks. And investment banks as an activity will be dealt a death blow. Even in the United States, largest economy in the world and so on, the regulators have allowed the financial institutions time in order for them to make the changes. And I think not allowing the investment banks enough time and so on, as well as there is another aspect which is very important. The investment banks that run into problems as a result of the global financial crisis, by and large, have not been supported in this part of the world. There has been a few exceptions, but by and large, they've been, left on their own. And unlike what's happened elsewhere, And I think part of the reform that needs to be looked at, in terms of, in the region, and in Bahrain in particular, is not just to look at giving support to the government for housing or other projects and so on, but also to look at market solution for these financial institutions. Because if you have financial institutions which stand on strong grounds, okay, they will be better able to participate in the reactivation of the economy. I think that theory is an interesting one. It reminds me of medicine in the Middle Ages, where they used to, the first thing they think about and the correct thing to think about was to bleed the patient. Unfortunately, what ended up was the patient was bled to death. So this is what can happen, all right? You can talk about, let the fittest survive, but the damage that will take place in terms of the economy and the damage that will take place in terms of confidence and trust is going to far outweigh the lesson that you're going to put across. What I'm suggesting here is that there is a middle road, all right? You try to save, all right, what can be saved and supported. You see, a lot of these institutions, some of their problem is not because they've necessarily done everything completely and so on. A lot of them, their problem is liquidity. They have assets, okay? These assets, particularly investment banks, because investment banks typically invest, wait a number of years for that investment to take the shape for them to sell it and so on, all right? And a number of them have invested, and their assets probably are still in good shape, but they're not able to have the cash flow in order to keep operating. So it's a question of liquidity more than a question of the quality of the asset or a completely wrong decision in making the investment in the first place. So that's why I'm saying, I'm not here talking about supporting a wrong practice or a bad practice. No, all right? And even if it's a wrong or bad practice, surely you can isolate that decision and take out that person who is responsible for it and replace him with a better qualified and competent person to run the organization. You should not make the whole organization or the market suffer because of individual actions. Surely you can isolate those individual actions and deal with it separately. Our business model that you alluded to, and it's the business model that's followed in the region, what we do, we underwrite a transaction and we sell down that transaction, we move on to the next transaction, right? And the challenge that we're facing today is that the regulators are saying, we don't like that business model, because they're concerned if you're not able to achieve a sell down, then the investment gets stuck on your books. All right, and if it gets stuck on your books, it means you have less liquidity to go for the next deal. All right, and therefore they are closing down the window as much as possible of how much you can hold on your balance sheet, you know, and how much, therefore, how much you can underwrite and commit to the market. And basically, you're starting to shift towards what I would call the European model, European-US model, where you have a general partner, a GP, and a limited partner relationship. The bank becomes the general partner. It doesn't use its balance sheet. It gathers fund for investment opportunities. All right, they could call it, I don't know, student accommodation fund in London, or student, or you know, whatever, you know, fund, and then they will bring in a number of investors, and then they will bring in investment opportunities. And therefore, what's happening, you're distributing the risk, okay, among a number of investments versus the model that we have where the risk is concentrated, all right? And at the same time, you're not using your balance sheet, you are using the balance sheet of the investors themselves, all right? And you're getting a fee for it. And this is the practice of, you know, of the major of the investment banking in Europe and the US. And it is that transition which I believe, you know, looks like the road we're going to, that we need time to be able to transfer from the present you know, business model to the fund approach, with a lot of difficulties and loss of sleep. But seriously, you know, you see, unfortunately, this uncertainty makes it very difficult for you to take, you know, a long-term view on a project. You're likely to look at things on the shorter end, which is not good for the global economy. You need investors who take long views, you know. I'm not saying they're not around, but they're much fewer in number than they used to be, because people have been, you know, scared of the risk of the market, and therefore you need to remain, you know, relatively medium term, I would say, you know, in the market. You need to diversify your risk. We are looking at a fund today for what I would call mid-market private equity firms in Europe and the US. We're setting up that fund with another major European entity. And the purpose here, because we see there is value that to be had, you know, out of this exercise. And you are distributing the risk. So you have to manage the risk. You have to be, you know, cut down the horizon that you have. And, okay, it would be good if you be able to get cash yielding in the investment you have. Now, with properties and real estate, it's possible, all right? That, you know, you can get a property and you can add certain value to it and it will have cash yielding and so on, all right? With private equity, most of the deals are not that. Most of the deals is that you take a view, all right? You take over a company, you restructure the company, 4 or 5 years down the road, you sell it, hopefully with an enhanced value, all right? But that's going to be the challenge going forward and so on, of managing, you know, your risk and managing your liquidity. And that's going to be the major risk that we face.